A very good evening to everyone. Welcome to our pre-budget webinar 2025-26, What Lies Ahead for the Indian Economy. With the union budget just around the corner, all eyes are on the policies and reforms that could shape the trajectory of our nation's economy. From identifying key growth sectors to devising effective investment strategies, today's session aims to uncover what we can expect and how it could influence the Indian economy and markets. We are so honored to have our distinguished guest speaker, Mr. Harsha Upadhyaya, with us today. With an illustrious career spanning over 26 years, Mr. Harsha Upadhyaya is a highly respected figure in the fields of equity research and fund management. Currently serving as the Chief Investment Officer, CIO Equity and Debt, he is also a chartered financial analyst certified by the CFA Institute. Mr. Upadhyaya's academic credentials are equally remarkable. He holds a Bachelor of Engineer Mechanical degree from the National Institute of Technology and a postgraduate management degree in finance from IIM Lucknow. Throughout his career, Mr. Upadhyaya has been associated with some of the most prestigious organizations in the financial world, including DSP BlackRock Investment Managers, Prabhudas Leeladhar Private Limited, SG Asia Securities, Reliance Group, and UTI Asset Management Company Limited. Recognized for his unparalleled insights into the complexities of the financial markets, Mr. Harsha Upadhyaya remains a guiding force for the industry, exemplifying excellence, expertise, and unwavering commitment to finance stewardship. I'm sure Mr. Upadhyaya's unparalleled insights will help us navigate the possibilities and challenges that lie ahead. Hosting this highly anticipated discussion is Mr. Vishnukant Upadhyaya, AVP Research and Advisory at Mastertrust. With over 14 years of extensive experience in the stock market, he brings an exceptional depth of knowledge in the Indian stock market, global economy, and macroeconomic trends. He is here to guide us through this insightful session. So let's dive into this webinar as we decode the budget expectations and explore the road ahead for India's economic journey. Also, you may write your questions in the Q&A section. They will be answered at the end of the seminar. Over to you, Mr. Vishnu.
Thank you. Thank you very much. Good afternoon, everyone. Thank you for joining us today for this pre-budget webinar. And a special thanks to Mr. Harsha Upadhyaya for graciously accepting our invitations to be a guest speaker. We deeply appreciate your time, sir. The focus of today's webinar will be on the expectations and prominent key announcement from the Union Budget 2025. Apart from that, we will also have a discussion on market outlook and a prominent investment theme for 2025. Basically, we all know that this budget holds a significant importance because it is a first full budget of Modi 3.0, and we all are expecting a strong and a concrete measure from the Finance Minister Nirmala Sitharaman to just stabilize the Indian stock market, as we are continuously seeing the ongoing bloodbath in the market. Well, guys, so let's dive into this discussion and gain a valuable perspective from Mr. Harsha. So, sir, again, Well, sir, again, very thank you for joining us as a guest speaker. So, my, first question to you: can this budget 2025 kickstart the Indian economy, and what is the key announcements we are expecting from this budget?
Good evening. As far as this budget is concerned, we still have about 2 weeks or so to go. However, the eyes will be on whether it'll continue in terms of the policy measures that we have seen during the first tenure of NDA or the second tenure of NDA. I think clearly that is something that one can expect, that it will be a continuation of the last 10 years of good work in terms of the policy measures, in rationalizing taxes, in terms of simplifying the overall tax structure, etc. Having said that, I would also say that over the years, the prominence of budget has considerably reduced. Reasons being, one, excise tax is no more there. We have GST, and the decisions of the GST panel happen outside the budget, union budget. The second is most of the import duties and the structures have already been rationalized for most of the product categories across the country, which means that there will be very small minor tweaks every now and then, but not a major change in terms of the import duty structure in that sense. As far as taxation is concerned, yes, there have been few reforms on the corporate tax side. Corporate tax today is at 25%, whereas personal income tax is at a higher level, and also a little more complex as compared to what was intended in the direct tax code. So there is a hope that probably you will see some simplification in terms of the personal income tax. But broadly, you will not see too many policy announcements in the budget in the recent times, because most of the policy announcements are happening outside the budget. For example, if you look at the PLI initiative on the manufacturing segment, that came outside the budget, which has seen quite a bit of enthusiasm among the manufacturing sectors, for example, has come outside the budget. And similarly, some of the policies on the defense or on the railways, for example, have also been outside the budget, not just in the budget document. So to that extent, to expect every government move to happen during the 1 hour or 1.5 hours of budget speech is not something that one should expect. However, clearly, I think the continuation of the policies will continue, which means that there will be focus on productive investments rather than spending on revenue items. There will be focus on building infrastructure and key sectors like defense, railways, power, all of this. If I have to look at a couple of things which are going to be crucial for the market participants at this point of time would be one, clearly on the fiscal deficit number. This year, I think we are likely to meet the budgeted fiscal deficit number. And also, given the fiscal roadmap, it is likely to be slightly lower for the next budget year. That's likely to happen, which should be helpful for the bond markets, at least in terms of the headline number, and also for the sovereign rating agencies. That would give a lot of comfort in terms of how Indian economy is positioned, how Indian government balance sheet is kind of at this point of time. Apart from that, I think all eyes will be on the capex expenditure. Last year, it was a budget where we were expected to spend about 11.1 lakh crores, which was a growth of low double digits on a year-on-year basis. However, as we all know, it has been running at a rate lower than what was budgeted. And this has happened in every election year. This is not something new. Every election year, whether you go back in history and look at it, or you look at some of the recent ones, you will definitely see the same trend where since the elections, general elections happen in the first quarter of a new financial year, that particular quarter, the spend is really low. And then the full budget is presented sometime in June, July, etc. in that year. And then the pickup happens. While that's a seasonal thing that we would see every 5 years or every time there is an election, but this time around, the delay was probably a little more than what was there in the previous few election years. One can attribute many reasons to it, but would also be because of the heat wave that was there in the northern part of the country. Then there was erratic weather patterns. The rainy season was erratic in various parts of the country, leading to flood, etc. I mean, there could be many such issues. However, from November onwards, there seems to be a certain clear pickup that we have seen. However, the entire April to November number is lagging the number that was budgeted. We expect that sequentially things will keep improving from December onwards, and as you see numbers coming out, January, February, March as well. However, there could be a slippage between what was budgeted for the full year and where we will end up this financial year. But that is more or less expected in the markets. I think markets would be more keen to see what will be the expected number on the capital expenditure for next financial year. I think if sequentially things improve and there is a reasonable number for next year, anywhere in the double-digit range, then I think markets will not be disappointed because, yes, there has been a delay, but now that it has picked up, I think market will take it in stride. The second thing that most participants are expecting is to see whether there will be any government action or policies to support consumption, because we have seen a K-shaped recovery, wherein urban and luxury consumption continues to be quite strong, whereas mass market or rural oriented consumption continues to be patchy. Now, this government, at least in the past, has clearly said that there will not be any sector specific incentives that they would give in the budget. So there may not be any sector specific benefits, but if at all there is a rationalization in terms of the personal income taxes, for example, since personal income taxes have not been changed for years, and also the corporate income tax rate is much lower than individual tax rates. If that happens, we don't know whether that's going to happen or not, but if that were to happen, then that would leave more money in the hands of individual consumers, and which could indirectly benefit revival in consumption. So I think both on capital expenditure and on the taxation levels, one should keep a watch. And anything positive that comes out on these two fronts would be really positive for the markets, because these are the two pockets which have kind of led to volatility in the market, both in terms of the business performance as well as in terms of stock performance. Within the capital expenditure part, I think the focus is going to be on infrastructure related expenditure, defense, railways, power. When I say power, even the traditional power generation as well as renewable power. I think these are the areas which will continue to see focus. The question will be what kind of numbers are going to come in terms of the budget number for these sectors. But broadly, I think all these will continue. Apart from this, I think the focus will also be there on affordable housing, which has been the case for last several years. I think that focus will continue, and also additional expenditure in terms of the healthcare overall ecosystem would also continue. So I think broadly these are the things that one can expect. As far as taxation on mutual funds is considered, I think last year there was a rationalization in terms of rates and some changes. Very unlikely that there will be further changes in the very next year. So I would say probably what has happened in the last year will continue this year as well.
Okay, so it's likely to be a mixed budget, and we are not expecting any significant changes in this budget. As you talked about, sir, personal tax. So definitely that will be a very good news, because we all belongs to a salaried class. And you also talked about a capex, and you stated that double-digit growth has been seen in a capex. Last year also we have seen a very good capex from the central government, that was around 11.11, as you mentioned, lakh crore. So what kind of growth you are expecting this year? Whether there will be a double-digit growth or a single-digit growth? How much rise you are expecting in a capex from 11.11 lakh packed for FY25?
See, if you look at our overall nominal GDP growth for the year, that should be somewhere in the 10% band, 10 to 10.5% band. So if that is the case, I think the capex number should also be at least that much. Ideally, it should be slightly more than that. But given the fact that we will also look to consolidate on the fiscal deficit number, we may see broadly that number. So anything in the double-digit territory should be a good news for the markets.
Well, sir, so the biggest concern is a government spending. By the end of November 2024, we have just seen 5.13 lakh crore of spending. That's somewhere around 12.3 5% is decline year on year basis. So what is more important, growth in capex or government spending? If this continues, whether government if increases a double digit number in a capex and government shuns away from the spending, so what is more important from the investor point of the view, or from the investment point of the view for this stock market?
So when I spoke about capital expenditure, I'm talking about capital expenditure of the government itself. It's the same number. You are right. As I said, in every election year, while the budgeted numbers were high, for the first few months, there was always a delay. But this time, the delay continued for more than 3-4 months. So until October, this number on a year-on-year basis was almost down 30% on a like-to-like basis, 30 to 35%. And November, it picked up quite a bit. But even now, for the entire April to November period, it's minus 12%, right? Now, the same kind of pickup is expected when the numbers come out for December, and also the spend happens for first quarter of this calendar year. So hopefully we should go towards that 11.1 lakh crores that was budgeted. But my view is probably we will falter by a small margin there. On that, we should again expect a double-digit growth next year.
Well, sir, then which sector is likely to receive the largest portion of the government capex? What do you think? Last year, I think we have seen MOD, Ministry of Defense, that receives around 6.23 lakh crore. And I quite remember that since July 2024, all defense stocks just stopped out, whether it's HAL, VDL, VEL, Mazagon, or GRSE. So, what do you think, sir? This year, the capex will live.
See, I think overall, capital expenditure will be focused on 4 or 5 different segments. I don't think there will be too much of a change in that overall focus. One, obviously, the infrastructure needs. When I say infrastructure, it includes roads, railways, airports, ports, all of the infrastructure that a country needs. It will also be focused on urban infrastructure like metros and few other things. Right, that will continue. Water irrigation will also continue to see focus, because I think that's something that has been dear to this government, and those policy measures will continue. While housing, as I said, affordable housing will continue to be a focus area. There may not be a government spend directly, but the push will be there for affordable housing, which also improves your infrastructure overall. It leads to uptick in cement demand, increase in job creation, all of that. So that's something will continue. And as you mentioned, defense, railways will also be focus areas. Apart from this, I think clearly power sector is another one, which will also see a lot of policy focus. There may not be direct government capex, because this is something where private sector is also participating. There are certain government also putting up capacities, etc. But I think the overall policy environment for the power sector will continue to be very, very conducive. And apart from this, this government in the past has been clearly focused on improving our manufacturing capabilities, not just in one sector, but multiple manufacturing sectors. I think that will continue to happen. So whatever little bit of a push that is required in various segments, I think some of those can also be part of the overall budget focus. But broadly, I think whatever you have seen in the last several years in terms of this government's focus, that is infrastructure, power, defense, railways, all of that should continue. To your question, in terms of how defense stocks have done in the past, what is likely to happen? See, these are two different things. One is the long-term policy and where it is headed. But what happens on a shorter term basis in the market is completely different. Every time it may not be completely dependent on fundamentals. There is also something called valuations, sentiments, flows, all of that. So that's a separate call. But from a policy perspective, I think the positives that we have seen in the past should continue to be there.
First, you just talked about some valuations also. So I just would like to talk about railway and defense stocks, sir. In for last 5 or 6 months, railway and defense stocks has corrected nearly 40% from their tops, right? As I also mentioned that, and there has been a significant price damage, price correction in the stocks. So do you think on a valuation front, these sectors, especially defense and railway, because these both sector has been a darling sector for the retail participants. So do you think, sir, valuations are comfortably and we can make a fresh long positions from the current levels in these sectors?
See, first of all, when you say comfortable valuations, what are those comfortable valuations? If you compare it to the market valuations, obviously there are many other sectors which are at a lower valuations than defense and railways even today. So compared to many other sectors, it's still higher valuation. Compared to its own history, it is at a much higher valuation. Some of it is justified. As we spoke, the long-term growth trends in the defense and railways in terms of the opportunities in defense and railways have also changed. So to that extent, a part of that higher valuation is justified. How much is justified is the question. Some of it is also has also come off. So to that extent, there are some opportunities in the sector now. However, since the entire sector is not trading at a very, very attractive valuation, and I say attractive, it's not something which is the cheapest sector or which is lower than its history in terms of valuations, etc. So I don't think one should take a sector-wide call. That should be left to the portfolio managers to manage the relative growth opportunities and what the valuations are showing, whether there is merit in taking a certain amount of exposure in the portfolio, what level that exposure should be cut, etc. I would say for a retail investor, it makes sense to take a diversified basket of stocks or take a mutual fund in the portfolio so that they don't worry about when to enter, when to exit, etc. Because if you're taking sectoral calls, you have to be very, very particular about entry and exit both. Uh, because the portfolio manager doesn't have the flexibility to really go outside that particular theme, right? If for example, if one was managing a defense fund, whether defense stocks are at an expensive valuation or they're at a cheaper valuation, whether there is a headwind or whether there is a tailwind, the fund manager doesn't have a option to not to invest in defense. They have to invest in defense and not invest in any other sector, right? So to that extent, all the decisions of your portfolio will be with the investor. So you will enter and you will exit depending on what you think of that particular sector. And that's where it becomes tricky because you go back in history and see every sectoral fund, while it becomes a very, very a strong flavor of the day and flavor of the year, etc. But we have seen enough examples, right? 2005 to 8 infra funds were in the flavor. But the next several years, they didn't do well. Similar thing happened with IT sectors. Similar thing happened with consumption. It has happened with defense railways. It will continue to happen in various other sectors also, because no one single business or no one single sector is going to outperform every year, every quarter, every period. So to that extent, if you're okay to make those valuation decisions yourself, you can manage that. If you cannot, then I think the ideal way is to come through diversified funds where the fund house will take that call of moving in and out of some of those exposures depending on what is the risk and what is the upside potential, what is the growth potential, what is the valuation that one is paying, all of that. So I think that's a easier strategy for an investor where you don't have to worry on an everyday basis. But if you're taking those individual stocks, I hope the investors are making necessary research on those businesses.
Yes, sir. So, shall I understand that we should adopt an approach of being a stock specific rather than sector specific, right? Well,
That's right.
so next question is, FIs are continuously offloading stock in a cash for last 4 year, and in 2024 we have seen offloading of more than 3 lakh crore. Well, sir, so do you expect something lucrative for FIs from this budget? Because many people expect that the imposing capital gain tax on FIs has been one of the major reason behind the foreign outflow. Apart from that, last year we have seen that कि यूएस के एफओएमसी ने जिस तरीके से इंटरेस्ट रेट को कट किया था, फ्रॉम दैट पॉइंट यूएस की जो बॉन्ड यील्ड है दैट हैज बीन क्लाइम्ड अराउंड 22%. सो व्हाट डू यू थिंक सर कि चाइना का मार्केट यूएस की बॉन्ड यील्ड में गेन या फिर इंडिया में कैपिटल जो गेन टैक्स इम्पोज होना, क्या मेन रीजन है एफआईएस का? और हमको क्या लगता है, आपको क्या लगता है कि इस बजट में एफआईएस के लिए कुछ ल्यूक्रेटिव हो सकता है? बिकॉज एफआईएस हैव around somewhere around $8 billion of investment in the India, and in the recent months we have seen just peanut out from the investment. तो क्या ये इन्वेस्टमेंट, ये जो आउटफ्लो है एफआईएस का, ये कंटिन्यू रहेगा या फिर गवर्नमेंट की तरफ से कुछ पॉलिसी मेजर इंप्लीमेंट होंगे उनके ऑफलोडिंग को रोकने के लिए?
चलिए ये बताइए कि रिटेल इन्वेस्टर जो इंडियन रिटेल इन्वेस्टर है, क्या उनका टैक्स कम हुआ है? उनका भी टैक्स बढ़ा है, राइट? लॉन्ग टर्म कैपिटल गेन्स 0 था, शॉर्ट टर्म कैपिटल गेन्स वो भी बढ़ चुका है, बट स्टिल पीपल आर इन्वेस्टिंग. Why do people invest? Because they believe that even after paying the tax, they will make money, right? So as long as you are going to make profits and if you're paying a part of that as taxes, why should it change the overall dynamics? Yes, I take your point that अगर किसी को 15% का रिटर्न का एक्सपेक्टेशन था और 0 टैक्स था और आज के दिन में 10% टैक्स है, तो you will have to build in that 10% higher return in terms of your overall market expectation. So, I mean, I am not in the camp to say that because of capital gains tax or any other tax, FIIs are moving out. Even when the tax was low, they were coming in and going out. Even when the tax is high or current number, they are coming in and going out. So I mean, for example, tomorrow you may say that why are all mutual funds buying? We will buy as long as we get inflows. Right? Finally, we have to buy in the market. To an extent, we will exercise our caution on valuations, on which sector looks better, etc. But as far as money is coming, we have to buy. Similarly, tomorrow, if mutual funds start to see redemptions, they will have to sell. You can't say, why are mutual funds selling? So whether it is an FII or a mutual fund, it's just a medium. What our investors do with our funds in terms of inflows or outflows, we are supposed to do that. Right? That is what FIIs are doing today. And also, I think there has been too much focus on FIIs in India. I don't know for what reason. As you rightly said, in the last 3 years, there has been hardly any positive number that we have seen on a net basis. There have been periods where they have put in money, they have withdrawn, all of that. But if you look at the last 3 year number, it's hardly any positive number, right? Despite that, in the last 3 years, there has been a significant return in the market, right? So, in the overall market, FIIs are one set of participants. They don't remain the only participant. So, to that extent, I mean, we are giving undue importance on one segment of the market, I would say. And also, we should remember that a lot of things have changed in the market. And that is also the reason why the FII fund movements are not really causing the same kind of volatility or the moves, whether up or down, in the recent times as compared to, let's say, 10 years. For example, 10 years back, they were holding almost close to a quarter of our float. As in, promoter के पास मान लीजिए कि 50-55% है, तो FIIs used to hold roughly about 25%. At that point of time, the domestic institutional investors, MFs and insurance put together, were about half of that. Right? That was point number one. And at that time, there were no SIP inflows, hardly any flows into the lump sum flows into the funds. And at the same time, once in a while, even like what we have been seeing, there used to be inflows and outflows from FIIs. But the money that was coming from FIIs or money that was going out from FIIs used to be the prominent flow, right? But if you look at last 3 years, as you see, there is hardly any inflow from them, hardly any outflow from them on a net basis, whereas mutual funds and insurance companies have been getting inflows. So in that respect, now what has happened? The FII holding in the country has gone to about 16.5% from a peak of about 24-25% to 16.5%. Whereas mutual funds and insurance companies, which were half of FIIs at that time, are now actually higher than FIIs on an overall basis. So as you can imagine, the balance which was not there earlier between FIIs and domestic, because they were really, really dominant in terms of the overall holding as well as the flows that were coming on a regular basis. Now that has completely changed. That has completely changed in favor of domestic funds. And the third important reason for not saying the same kind of market volatility, I'll give you just 3-4 data points. I mean, you don't even have to go back to global financial crisis or anything. Let's go back to COVID period. Okay. In the 3 months after COVID, the FII segment saw outflow of about 65,000 crores. And this was just in a span of 3 months. And markets fell, Nifty itself fell more than 30% in the 3-month period, right? Between October 22 to June 23, 21 to 22, you saw 4 times higher FII selling, which is about 2.5 lakh crores. Going by the same measure as what you had seen just after COVID, you should have seen much more downside volatility in the market. But during that period, markets fell only in the double digits, I think roughly around 15, 16, right? Now, just look at the last quarter. Last quarter, whatever selling has happened, it has surpassed all those numbers. And even in the first 15 days of this month, we have already seen close to $4 billion of selling. But what has been the market fall? It's much lesser than that. The reason being, there is another component which has come and given support to the market, which is your dynamic asset allocation or balance advantage funds, right? 5-10 years back, this segment was very, very small and many funds are new. But in the last few years, this segment has grown, which means that whenever the valuations go down, even if you assume no flows into mutual funds, if valuation go down to certain levels, these funds will have to increase their equity allocation. And similarly, when the valuations go up, they need to sell their equity allocations. So that is what is also cushioning the volatility that we used to see in the past. So these are a combination of factors which have meant that FIM money is not holding the same prominence as what it used to be in the past.
So the most important question is, where do you see Sensex by the end of December 2025? You see the market will close the 2025 with a 10 consecutive years with gain?
See, first of all, as a mutual fund portfolio manager, we do not give any targets for returns or market. But if you are a long-term investor, when I say long-term, at least a 3 to 5 year kind of a horizon, you will still make a good amount of money in equity. What happens in the short term, very difficult to say. But I think one thing is probably easier to say, that whatever kind of returns that you have seen over the last 4 years, especially after COVID pandemic, those are really abnormally high returns for equities, and that too without any correction, right? Those kind of markets don't sustain for a long period of time. It sustained for 4.5 years. That itself is a very big positive. From here on, I think there will be ups and downs in the market. But if you hold on, if you have a long-term focus, you will still do better than many other asset classes.
So for a long-term perspective, we are still, have a confidence in the Indian economy and Indian stock market, right, sir? So
That's right.
as we have entered in a earning season, and sir, in Nifty 50 companies reported a single-digit net profit growth for the second consecutive quarter in Q2 FY25. So are you, expecting any improvement in Q3 FY25? Or we will continue to, see some kind of disappointment from the Indians?
There will be some improvement, but I don't think it will be significant improvement. It will be a minor improvement. Our expectation is probably second half will be slightly better than first half. First half was about 3.5-4% year-on-year growth. I think full year we will end up with about 7% or so. I think second half is going to be slightly better. But whether that is good enough for the markets to really make a very strong up move, very difficult to say. But I think, I mean, if you have seen earnings growing at, if you look at the large cap earnings, for example, for the last 4 years, it's grown at about 17-18% CAGR. If you look at mid and small cap earnings, they have grown in excess of 25-30%. I think there has to be some consolidation. I mean, tell me which business continues to grow 30-35% every year without any business headwind or without any issue. So I think one should believe that there will be ups and downs. When you are investing in equities, what are you doing? You are investing in a set of businesses, right? Which business continues to grow without any hiccups? That's not possible. And that's why you need to diversify and take a call on valuations and make a diversified portfolio and keep a long-term horizon. As long as that is there, I think Indian equities will continue to give you decent enough returns. But one will have to probably not expect the same kind of returns that you have seen in the last 4 years. I think, as I said, those were kind of a bonus for investors. If you get that in the fifth year, you should take it as a bonus. If you don't get, you should not be undepressed.
Well, sir, so let's talk about some sector specific, basically, not for a short term, for a long term. So like PSU, energy, metal, realty, and a PSE, we have seen a very, sharp correction in these, sectors. Somewhere around 20% fall we have seen in these sectors. तो मैं वैल्यूएशंस की यदि हम बात करें तो क्या हमको लगता है कि जिस प्रकार प्राइसेस में करेक्शन आया इन सेक्टर्स के, तो वैल्यूएशन फ्रंट पे भी थोड़ा बहुत कंफर्टेबल जोन में अभी ये सेक्टर्स आए हैं, और यदि कोई एक थीमेटिक इंडेक्स के है तो ये फिलहाल अभी सेक्टर्स ठीक रहेंगे इन्वेस्टमेंट पॉइंट ऑफ द व्यू से?
See, if you look at pre-COVID and now, because that's the only period where we have seen one-sided returns. Except for large cap banking, there is no other sector which on a on the entire sectoral basis is lower than 2019 valuation. So purely on valuation, although we have seen 20-30% cut in some of the stock names, as a sector, none of the sectors have become as cheap as what it was pre-COVID, right? So that's point number one. Second, as I said, which I refer to for defense, railways, etc., where you need to be stock specific. I think that applies for most of the sectors. I think you need to be stock specific. I don't think at these valuations and at these points of time where the sectoral profitability has not been uniform, I don't think you will see a complete participation of the sector, right? That happened post COVID because of two reasons. One, the valuations were very, very cheap after the fall during COVID. Second, compared to everyone's expectations, almost every business performed very well, right? So you got the benefit of both of those. Now, not only earnings have been patchy and lower than what you were seeing in the past, your valuations are also not as attractive as what it was at that point. So, given that, I think you should not take too many sectoral calls. It's better to take a diversified approach.
Well, sir, so there are so many kind of investors. There are many investors who entered in the market in since a dot-com bubble, since European crisis, subprime crisis, and COVID fall. And there are many investors who entered in the market, in just early 2024. And for those, I mean, portfolios are seriously, bleeding. So what is your advice for those for a long-term point of the view? बिकॉज उन्होंने ऐसा कोई फॉल मार्केट में नहीं देखा है वी आर इन द मार्केट सिंस लॉन्ग यू आर इन द मार्केट सिंस लॉन्ग वी हैव सीन सो मेनी टर्मोल इन द मार्केट सो मेनी क्रैशेस इन द मार्केट एंड वी हैव बीन यूज्ड टू ऑफ दैट बट वो लोग जो कोविड के फॉल में एंटर किया मार्केट में या फिर अर्ली 2024 में एंटर किया मार्केट में एक ट्रमेंडस गेन के साथ अपने पोर्टफोलियोज पे बैठे हुए थे और सरप्राइज ये जो मार्केट में फॉल आया है इनफैक्ट मैं यदि मिड कैप स्मॉल कैप की बात करूं तो अपार्ट फ्रॉम द इंडेक्सेस स्टॉक्स हैव बीन करेक्टेड मोर देन 30 और 40%. Although indexes has been corrected around 13%, बट स्टॉक्स की यदि हम बात करें तो 30 से 40% तक का करेक्शन हमको स्टॉक्स में देखने को मिल चुका है. तो उनके लिए सर आपकी क्या एडवाइस होगी यदि अभी वो प्रॉफिट में बैठे हुए हैं एंड इफ यू आर एक्सपेक्टिंग मोर पेन इन द मार्केट इन डेज टू कम बिकॉज यू आर ऑल्सो एक्सेप्टिंग दैट कि कॉर्पोरेट अर्निंग्स में एक स्लाइट इंप्रूवमेंट हो सकता है बट वी आर नॉट एक्सपेक्टिंग एनी ह्यूज इंप्रूवमेंट सिग्निफिकेंट इंप्रूवमेंट इन Q3 अर्निंग FY25 एंड वो चाहे गवर्नमेंट स्पेंडिंग की वजह से हो या किसी और रीजन की वजह से हो जो प्रॉफिट में है उनको अपना प्रॉफिट बांध के निकल जाना चाहिए या फिर ये लेवल है एवरेजिंग करने पैसा है तो यहाँ एवरेज
Vishnu, I mean, I won't be able to comment on somebody else's portfolio. One, I do not know what stocks are there in that portfolio, why those stocks were bought, what is the reasoning, how much allocation has been done, whether it is up to their risk limit, whether they are over leveraged. I have no idea, right? But I can speak only from a mutual fund perspective. If you are looking at a mutual fund, mid cap or a small cap fund, if it is a well diversified, well managed in terms of risk, none of those funds have seen 30-40% kind of an erosion, right? And the large caps obviously have not seen that kind of erosions. So I think, again, if you have all the ability to research a company, understand the valuations, understand the risk, then you are expected to do the stocks directly. Otherwise, the professional management is a better route to get that return. I think I would still say that. As far as what to do now, I think if you are, as I said, if you are a 3-5 year investor, you will still get handsome returns from equities. It may not be same as last 4 years because last 4 years have been very, very exceptional years. You should expect up and down in the market. It cannot be one-way street. If you come with these kind of understanding, then you will not be disappointed. But if you are looking at 2024 returns, if you are looking at post-COVID returns, and if you expect that to continue and come into the market, if you take risk, then that may or may not fructify.
Well, sir, sir, do you expect any announcement from finance minister to protect, US facing businesses like IT, pharma, or textile? Because we know that on 20th of Jan, Mr. Donald Trump will assume office, and there is a news that he will sign around 100 executive orders. और वो ऑर्डर्स कुछ भी हो सकते हैं ट्रेड फ्रंट पे भी हो सकते हैं बिकॉज इन 2017 में भी हमने देखा था एक ट्रेड वॉर हुआ था चाइना और यूएस के बीच इसमें ग्लोबल इकोनॉमी को भी डेंट हुआ था लॉन्ग टर्म पर्सपेक्टिव से ऑल्दो अभी फेस्ड अवेटिव रिटर्न्स यस इन अ वेरी शॉर्ट टर्म वोलेटिलिटी वर देयर सो कि फाइनेंस मिनिस्ट्री से अनाउंसमेंट हो सकते हैं कि यदि इंडिया के ट्रेड रिलेशंस को लेके कुछ इम्पैक्ट होता है यूएस की तरफ से, तो हमारे बिजनेसेस थोड़ा सा प्रोटेक्ट रहे?
Couple of points. Those who invested in 2016 or 17, I don't think they're disappointed. So if you're a long-term investor, even with whatever happens, after that COVID has happened, after that Ukraine war has happened, there will be several things in the next few years. Who knows? Nobody knows. But still, as long as businesses continue to do well, as long as portfolio managers are going to buy good stocks in the portfolio, you will get it. So that's point number one. Second, we have seen 4 years of Trump. I don't think all 4 years, all markets were down, right? If somebody is believing that's going to happen, I don't think that's going to happen. And first of all, nobody knows the policies. Many a times, politicians make a lot of promises before the election or during the elections. Many of them may or may not be done, and may not be. It may not be possible for them to, right? For example, if they put too much tariffs and if imports into China stops, whether they have the manufacturing facilities to produce those goods overnight, they don't have. For example, if you put a lot of restrictions on IT services, for example, do they have the required skill set in the country? Answer is no. So I don't think it's going to be a doomsday scenario. But yes, I mean, there could be changes in policies whenever there is a new government, new setup. So to that extent, there will be volatility in the market. Then you have to sit back and see whether that volatility is going to harm those businesses from a medium to long term perspective, or it's just a noise that is coming in the market. And ultimately, it's about valuations. At what valuations you are going to buy those companies. For example, in COVID, nobody knew when the world is going to get all right, but valuations were so attractive, people thought that it's a good time to invest, right? And then slowly, one after the other, things improved, and then people made money. Finally, you have to decide that there is a certain amount of money, and I'll allocate what percentage to equity and how long I'm going to keep that. But if you're looking at markets from a very, very short term perspective, what happens to every event, I don't think there is an answer to that. And that's not the right way to invest in the market. If you're a trader, maybe that's the right way to do it. But if you're an investor, I think you should not worry about these events, because every 5 years there is an election in India. Every few months there is an election in some state or the other in India. There will be elections globally all over the world. Every now and then there will be wars. There will be some unforeseen events. There will be individual businesses which will see issues, right? There is no guarantee that all the 50, 60 stocks that you have in the portfolio are going to do equally well. There will be some headwinds in business, all of that. And that is where I think even the expert portfolio managers do not keep few stocks in they always keep exposure very, very measured and calibrated, because even after all the research that we have done, there could be ups and downs, and that's what we try to manage. But if you are looking at overnight success, it may have happened in 20 to 24 period because the markets were going up one way. It didn't matter which stock you bought, which sector you invested in. But I don't think that's going to continue in the future.
Well, sir, India's inflation is currently in a RBI's comfort zone, that is around 2 to 6%, slightly above the ideal level of 4%. That is, yesterday we have seen 5.22%. So, well, sir, so if you talk about the RBI's global counterpart, I mean, US Fed continuously reducing interest rate, 100 basic points, it has been reduced in, 2024. So, do you expect, sir, RBI to, give some relief in 2025? And how many rate cuts are you expecting from the RBI?
First of all, I think this is again a wrong way of looking at monetary policies. Just because US does interest rate cuts, it doesn't mean that every other country has to do it in the same fashion. For example, post global financial crisis, US from all the way up, they went down to near zero. Did India go down to 0% interest rates? Now, last few years, they have gone up from near zero to 5% or thereabouts, right? Now, did we increase our interest rate by 5 percentage points? No. So that's why even if they have done 100 basis points in the last 1 year and we have done zero, we should not be surprised. It is all about our monetary policy, whether we were uh, following the same monetary policy as them or not. I think the zero interest rate policy is coming to the roost, and they are paying a price for that. Inflation has been sticky there, and we have all seen what has happened to those economies, etc. That's a separate discussion. So first point is, I don't think there is a one-to-one correlation between what US does and what some of the emerging market monetary authorities would do. The second is, even if there is interest cut this year, it will be a shallow rate cut. As you rightly said, RBI's intended inflation level is about 4%. If you have a positive real rate of, let's say, 1.5%, that comes to about 5.5%. Right? Even 4% is intended. It may not be 4 all the time. It may be 4.5%, 5% also at some points of time. Right? So if that is the case, the ability to really cut rates beyond maybe two rate cuts of 25% each doesn't exist at this point of time. It will be a shallow interest rate cycle. And also we should remember what's happening to our currency, what's happening to our reserves, and more importantly, in the last 10 or 15 days, surprisingly, the crude prices have moved up from about $70 per barrel to about $80 per barrel, which means that as you go ahead, you will see inflation increasing because of how this commodity has done. So given all that, I really do not believe that there are too many interest rate cuts in 2025 at this point of time, given the current environment. If crude goes to very low level, or if something else disappoints on the growth side, we don't know. But as of now, I think penciling in more than two cuts, I don't think that should be the base assumption.
Sir, we have seen a very tremendous fall in a domestic unit against the greenback, right? So it's currently trading around 86 point something. Well, sir, what kind of measure should central government finance ministry should take to prevent rupee fall against the greenback? And what is the repercussions of this rupee fall on the sectors like, chemical, metal, फार्मा, आई मीन आईटी, ये कुछ बिजनेसेस हैं, उनके जो अर्निंग्स हैं, रेवेन्यूज हैं, वो डॉलर में ज़्यादा होती है, इन टर्म में एक्सपोजर यूएस की तरफ ज़्यादा होता है। तो क्या आपको क्या लगता है सर कि ये रुपए की जो या फिर ये जो बजट है इसमें कुछ कॉन्क्रीट मेजर्स लिए जाएंगे ताकि इस रुपए की जो गिरावट को उसको कहीं हद तक हम होल्ड कर सकें?
See, I don't think the rupee fall is because of India specific factors. It is more because of how dollar index has moved in the recent times, and also the fear around trade tariffs coming in and how that's going to impact emerging market economies, etc. And obviously there is some impact of FII selling because they have taken out dollars from the market. So all of this. So I don't think one should be really worried in terms of our own economy to feel that there is a pressure on currency. I think our external front is still very manageable. I don't think there is a scare. But every year in the earlier period, we used to probably depreciate by about 3.5 to 4%. I'm talking about a decade earlier. Now that has come down. And for the last 3-4 years, we were almost stable, one could say. So to that extent, it may not happen every year, but in one particular year, there could be slightly more than 2.5% or 3%. That's possible. So I think that's what we need to pencil in now. I don't think there is such a scare on our currency at this point of time. In fact, many of the other emerging market currencies have depreciated more than us, right? And also, if you are an exporter, you would want to be competitive. If your currency is not depreciating and Chinese currency is depreciating or some other competitive currency is depreciating, you will be at a disadvantage. So the government will have to balance the interests of every stakeholder, right? Not just importers, not just investors, but also the exporters. So I think they have to do a balance of that. But I don't think there is a big scare on currency at this point of time because of India specific factors. Whatever is happening is because of global factors. Hopefully there will be some stability at some point of time. Now, where do you see the benefits coming from? Going to or benefits going to? Clearly, all the exporting companies will be beneficiaries, but it will be a short-term benefit, right? It's not that it's a permanent benefit. I'll give you a simple example. 10 years back, our rupee dollar rate was about 50 roughly, right? Today we are at 85, right? If rupee was the only determinant with almost a 70% depreciation, 50 to 85, right? I'm taking round numbers here. Our IT company should have made tons of more money. Our pharma company should have made tons of more money. But it doesn't happen because the moment there is a rupee depreciation, the importer sitting outside India or the person who is buying IT services somewhere outside India, they also know that the costs have not gone up, but profitability has gone up. So it's natural that those businessmen will also negotiate for a better price. So you may get an advantage for some period, but when the renegotiation happens, then again things will come back. But yes, in a depreciating environment, it is positive for all the exporters because they will be able to cover their cost easily and also make slightly better margins, etc. And those who import on a large basis will be the ones who will get impacted in the immediate short.
So last question, if you are comfortable to say, what sector you are looking that can generate alpha over the market in 2025? If you are comfortable.
No, I think it has to be a diversified approach. As I said, I mean, in our portfolios, if you look at, there will be at least 7, 8 big sectors which have decent exposure. I think that's the way to do it. And also, it's not that you take position on January 15th and you don't review it for the next 1 year and you will get good results. You may have to review it on an ongoing basis. I think on this call, it may not be possible to explain how we do our portfolio management completely. But I think those who cannot make that research themselves, mutual funds is the best way to participate. It's lesser headache and also tax efficient, because if you do it on your own, if you do short-term trades, there is a higher tax. If the same by mutual funds, there is no short-term capital gains tax. So I think overall, I think mutual fund investments from a long-term perspective is better.
Well, sir, now let's take some questions. So there has been. So हमारे एक I request everyone to please mention their name while putting questions. So already we sir has described the rupee fall कि ये क्यों हो रहा है. So Mr. Jagmohan Singh पूछते हैं, sir, do you think the government should do more to encourage the growth of the electric vehicle industry in the union budget?
What industry?
Electric vehicle industry, sir. EV.
Electric vehicle. I don't think you will see too much focus on that at this point of time, because the debate is still on whether that is really beneficial from an environment perspective, right? Because still we are using thermal electricity to run our electric vehicles, right? Finally, the source of power is still thermal power. So when you look at it from the production till the usage, I don't think the environment impact is so high. That is one. Secondly, even today, the adoption is very less because of the high cost, because of lack of infrastructure. If you have to move within a city, it is still easily manageable. But if you have to move outside the city in an electric vehicle, it is still a challenge. So I think there are a lot of challenges in terms of pushing it beyond the current level of penetration, I would say. So it will be a slow and gradual. And also there is another debate that is going on, whether EVs is the best route or a hybrid technology is a better route. I think over a period of next 3-5 years, we will see which technology is better, etc. And one more point that we need to remember is, in the electric vehicles, we have not seen one full cycle of life cycle of a vehicle, right? Only when you see the first owner selling it to the second buyer, you will see what is the residual value that he gets. And in India, people are very, very sensitive on the residual price that they get for their old vehicles. If there is not similar experience as compared to IC engine vehicles, then I think the uptick for EVs, whatever we have seen until now, can also be under question if the residual rates are lower than expected. And that will be seen over the next 1-2 years.
So second question is, Mr. Rakesh asking how much effect on India's trade deficit if new USA government increases the tariffs? Will high tariff on China creates opportunity for India? If yes, then which sectors will get most benefit?
Again, on a lighter note, I don't think even, I mean, anybody knows what President-elect Trump is going to do. Forget anybody else doing. I don't think he himself knows what he's going to do, because he's been changing his statements, his policies quite often, right? So first of all, we don't know which sectors will have higher tariffs, lower tariffs, which countries will have, but here specifically mentioned until now Mexico, China, and Canada as three countries where from where the imports have been very, very high and where US is getting hurt in terms of their domestic economy. So fair to assume that these are the three countries which will see higher number of trade barriers. So to that extent, we should not be in that red list. Point number one. Second, compared to China, our exports to US is very, very small, right? So we are not an export dependent economy, and also we don't export as much to US as China or Mexico or Canada export. So from an overall focus perspective, I think US focus will be on these countries rather than India. And the third and the most important point is our exports to US is mostly in the form of services. For example, IT services. And services cannot have tariffs. It can only be on goods. So services can other issues like H-1B visa availability, various other kind of barriers, but I don't think there can be tariffs on IT services. So overall, first of all, we don't know what exactly will come out of the policies. It is still speculative at this point of time. Second, whatever happens, I think on a relative basis, we will be less impacted. And probably it'll also open up a little bit of export opportunities, for example. For example, let's assume that there is a sector where today both China and India are competing for exports into US, and tomorrow there is a high tariff on Chinese exports. Then automatically Indian exports will become a little more competitive. So that's an opportunity that we will see. But without knowing which sector is going to have how much, which country is going to have how much, will be very difficult to speculate on this.
Right, sir. So there are so many questions. We'll try to take them in brief. So Mr. Prashant Bhatia is asking, a lot of mutual funds that investors have withheld are currently in red with regard to the current downfall of October and January. Even of those with a long-term holding of 3 to 4 years. Is this a worrisome state? What Kiger should we expect with respect to mutual fund for FY 25-26? I mean,
No, I don't think if you have invested for 3 years, there is a negative return. In fact, I can see the returns of Kotak funds in front of me. Our funds have all given close to mid-teens on a CAGR basis, on a 3-year basis.
Yeah.
I don't think that's correct.
I think entered in the market in early 2024, I think later part of 2024. So perhaps
But
their
that's not 3 years.
NAVs,
But that's not 3 years.
yeah. Perhaps their NAVs is currently down from their purchasing point. So एक हमारे जो यूजर हैं ही इज राइटिंग दैट वेल सो ये ऑलरेडी हम आंसर कर चुके हैं सर इसको तो मिस्टर अमितोष कुमार ये सर जानना चाहते हैं कि व्हाट इनिशिएटिव्स विल द यूनियन बजट 2025 इंट्रोड्यूस टू बूस्ट इंडियाज मैन्युफैक्चरिंग सेक्टर एंड अट्रैक्ट फॉरेन इन्वेस्टमेंट टेकिंग इनटू अकाउंट द रीसेंट ट्रैजेक्टरी.
See, I think Make in India or the PLI initiative is happening even otherwise, right? So that focus will continue. I don't think there is any policy push that is required from budget perspective, but there could be a few tweaks here and there in terms of taxation, etc. But that policy is an ongoing policy. So I don't think there has been any lesser focus on that policy in the recent times.
I mean, कुछ special announcement to our manufacturing sectors we are expecting as such like in the budget?
No.
So Mr. Ajay Sharma is asking how Indian market will going to impact in coming future in a view of India faces $14.6 billion tariff burden if US impose 20% duty, and all there is a news about US sanction on Russia which will going to impact heavily on the India's crude import.
See, I've already spoken about tariffs. We do not know which form and shape it's going to come. So at this point of time, it will be purely speculative to talk about it.
So सर इनका जो सेकंड पार्ट है क्वेश्चन का कि यदि यूएस का कोई सैंक्शन इम्पोज होता है रशिया के ऊपर
It's already happened. I mean, the reason for crude to move from about $70 end of 2024 to currently about $80 is also partly because of the newer sanctions that have Russian crude oil. We need to see whether it's a short-term knee-jerk reaction or whether it's going to continue for long. As long as it is in that 80-85 band, I think it is still manageable at current foreign currency rates. If it goes beyond those levels on the higher side, then obviously it's a negative for our inflation. It's a negative for our economy, all of that. Similarly, if it falls to, let's say, $60 or so, it will be very, very positive for our inflation and our markets and all of that. So in this band, I don't think, I mean, one can take such a great view. So we'll have to wait and see whether this is a short-term reaction from participants or whether it continues.
So one of our users are asking how much effect on India's state deficit if a new US. I mean, it's a already taken question. Nishant Trivedi is asking how a new investor can research the company. What should be the path of research? So could you please
Maybe you can
want to
enlighten
speak on
them
this, sir?
because I mean we are in the mutual fund. We will be able to talk only on mutual funds.
Well, sir. So, well, sir. So, I think most of the questions have been taken out in the webinar. So there is no any fresh question pertaining to this webinar, pre-budget webinar. Thank you very much, sir, joining us today. And seriously, it has been a very insightful session with us. And looking forward to connect with you again in some days. So thank you very much, sir, for joining with us.
So much. Thank you so much.
Thank you, everyone.